All right, we're going to recap investments for one final time. We're going to talk about a collection of recordings that I made for you, long-term planning, and then Social Security, and to discuss why we want to pay attention to Social Security, at least in the short term. Remember, we have a division of definitions. We have savings and we have investing. And savings is the amount of trying to accumulate money and have from your income. And so the investing piece is taking your savings and putting it into an investment portfolio that will increase your overall growth of your savings so that you will have this for the future, presumably in terms of retirement. The first of things that we studied about investments was, of course, stock. But an enhancement of stock is and are mutual funds, and I want you to take a look at the next clip to see if we have this under our belt.
What are mutual funds? Presented by WallStreetSurvivor.com. A mutual fund is a collection of stocks, bonds, cash, and other securities that are managed by a professional. Generally, people buy mutual funds because they want a simple way to invest in a diversified portfolio with the security of knowing that someone will be watching it. Here's an example of how a mutual fund works. Here's Will. Will has been investing for a long time with consistently awesome returns. People are always asking him for investment tips and financial advice. So Will decides to start a fund where he will manage and invest for people. He registers with the authorities, gets the approval, and sets up a mutual fund. He calls it Will's Fund. Because Will is such an awesome investor, he is able to convince 10 people to invest $1,000 in Will's fund. Each investor owns one share of Will's mutual fund. Each share is worth $1,000. This is referred to as net average value. With the cash, Will invests in some stocks and bonds and leaves a little left over in cash. This portfolio is referred to as his assets under management. Will also takes a small percentage of the fund as his fee. This is called the asset under management fee. Let's fast forward 3 months. Will has made some really wise stock decisions. He was able to grow the portfolio from $10,000 to $11,000. Because he made an additional $1,000 and he has 10 shareholders, each of Will's friends will make $100, bringing the net average value of the mutual fund to $1,100. Will's fund is an example of a close-ended fund. He raised the money for his fund through his friends and is not accepting any more funds from outsiders. If one of his friends wants to sell their position, they would have to trade it to another investor. Mutual funds are traded on the stock exchange. To learn more about mutual funds, check out the Learn Center at WallStreetSurvivor.com.
Now, this clip talks about closed funds. There are also things called open funds, and open funds have, in theoretically, an unlimited number of investors with an unlimited amount of cash flowing into the mutual fund. Mutual funds are valued at their net asset value, and this is a per share value. Remember, net asset values are established at the end of the trading day, and the net asset value is essentially the assets minus liabilities divided by the number of shares outstanding, and at the end of the day, that is the price that you're going to pay to purchase the fund or the price that you will receive if you sell the funds. Now, the question again always is why do you invest in mutual funds? They are generally affordable. They are generally liquid. They diversify your portfolio, thus eliminating non-system risk. They create dividends and capital gains that allow your portfolio to appreciate, and they are professionally managed. And remember from this class, if nothing else, do not invest in no-load funds unless you are absolutely desperate. A load is a fee for purchasing or selling a fund. And what it does is it reduces your return. And there are many, many no-load funds, so there is not much reason, in my view, to buy a load fund. Now, with mutual funds, there's an innovation that was made with mutual funds, and these are known as index funds. What is an index fund? Watch the next chart.
Hi, it's Patty Hirsch at Marketplace. So an index is kind of like a basket of shares of select companies, right? So you can have a small basket like the 30 shares in the Dow Jones Industrials, or you can have an enormous basket, all right, like the more than 3,000 shares that are in the NASDAQ index. The NASDAQ, of course, is a very tech-heavy index. Now, an index fund is a way for individual investors like you or me to get our money to move in the same way as these indices without having to buy every single one of the shares that's in the index. Like you wouldn't want to be buying all 3,000 shares on the NASDAQ, for example. So to show you how this works, I want to introduce you to Jimmy. Right, Jimmy's a big fan of technology, and he actually wants to invest in a tech index fund. So what he does is he finds a fund that will actually replicate the movements in the NASDAQ. And the way this works is these managers take Jimmy's money and all the rest of the other investors' money that invest in their fund, and they buy a certain number of shares of every single company that's in the NASDAQ index. And what that means is when the NASDAQ moves up, when technology does well, it means that Jimmy and those other investors' investments improve. And when NASDAQ does badly and technology falls, it means that the value of those investments also fall. Now, the great thing about an index fund is that you don't have to worry about the sticky business of selecting individual stocks, because that business is already done for you. Just buy the index. And that means, of course, that you don't have to spend lots of money paying upfront fees or whatever to these investment managers that would be picking those stocks for you. It also means you don't have to worry about missing out on some great gain in technology when a technology index bursts through the roof. However, if things go the other way and technology corrects and you start to see the NASDAQ fall, well, you could be left very badly needing a drink.
And finally, we have the issue of electronic traded funds. The key thing to think about ETFs or the key thing is that you can trade these funds throughout the day like a stock. If you will watch the next slide.
What is an ETF? Brought to you by WallStreetSurvivor.com. Do you know how to buy gold? How about investing in a foreign market or follow an index like the Dow? If you don't, you're not alone. Buying commodities, investing in markets, and following an index has been almost impossible due to high costs, strict laws, and other restrictions. Bummer, right? Enter exchange-traded funds, better known as ETFs. ETFs are designed to follow the price of a specific basket of assets and are traded on the US stock exchanges. You would buy ETFs exactly as you would stocks by entering the symbol and quantity. Just like stocks, you can even use different order types to buy and sell them. ETFs are basically an easy and cheap way to gain exposure into a sector that would have otherwise been extremely difficult. Here's Jane. Jane wants to invest in gold. She can do this a few ways. She could buy a brick of gold or a gold coin or maybe melt down her jewelry. But these ways are difficult and time-consuming. Or Jane could buy shares of a gold ETF like GLD, which follows the market price of gold. She can do this for a fraction of the price and with much less effort. Let's say Jane now wants to buy an index like the Dow Jones because she thinks the entire general market will go up. Jane could buy all 30 companies that make up the Dow Jones Index for around $11,000, or Jane could buy shares in an ETF that follows the Dow like DIA for around $110. Here Jane is exposed to the same index, but paid 1/100th of the price and avoided the headache of buying 30 different stocks. As you can see, ETFs provide simple investment opportunities that would have been otherwise very difficult. Research and trade ETFs for free with the ETF Center on WallStreetSurvivor.com.